Hello, can you hear me? Can you hear me?
Hi, now I can hear you.
Cool, thanks. Okay, so it's the last one I'm doing for this year. Quite excited about this. So the way that I'm going to do it is that I'm going to, like always, we're going to talk about for 10-15 minutes, and then I'm kind of going to open it up for us to kind of have a little bit of a chat. A few things are happening right now in the market, and I kind of, I just feel that, I basically want to share some of my thoughts. So I'm just going to kick right into it. iPhone 6, can you hear us? Can you just say, can you hear me?
Yes.
Okay, cool. Basically, I'm going to jump right into this, and I'm going to speak about three investors that kind of three traditional value investors. But like I did last week, rather than just go and say, oh, these guys are amazing, blah, 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 I kind of wanted to say, some drawbacks of their particular investment styles. Now, what I want to explain, and I don't follow a lot of what, for example, Mark Minervini does. He's a trader, but to my knowledge, and this is like really spotty knowledge, he's the only trader that I know that won twice the American Championship. I think once was like 1998 or something like that, or 1996, and the other one was in 2022. And why I highlight that is that if you are really good at what you do in terms of investing, I don't buy the argument that things were different then and things are different now. The same principles will need to apply whether you're going to invest in 2024 or whatever. So I feel that, just to kind of understand that within this context that I think is really, really important, because we say, oh, things used to be like cheaper, things used to be like less followed or more liquid or less liquid. And it's nonsense. If there is value to be had in the position, the market will come around and agree with you. You don't need to kind of overthink it. But if there is no value to be had, then the market is just going to take you apart. Now, the first investor I want to talk about is Walter Schloss. That's my preamble at the start, why, things last, and strategies, as long as you refine them so that this is within my sphere of competence, this is, this I need to nail. So when Walter Schloss, his track record was 47 years. So it's like pretty much 5 decades, This is somebody that came out of the Great Depression in the US and was investing in until 2002. And a lot of people say, oh, he didn't understand things, but, he clearly understood. And in fact, his performance from 1992 to approximately, I think it was 2001, it was lagging the S&P. Well, that's 11 years, man. 11 years of lagging. And this, investing is always brutal. Investing is really just cutthroat. You always have to kind of be like that song goes, you always kind of have to come up and stack the chips, you always have to come up and perform. And you're only as good, your reputation doesn't last forever. You need to kind of continue to deliver. But in 2002, when the whole of the market collapsed, Walter Schloss's strategy was strong enough in that year that it actually allowed him over that 10 years to end up outperforming the S&P. Now, again, I said this at the start, so the guy was investing for 47 years. So it's not that it was just some kind of lucky fluke that happened. It was, it's a strategy of understanding what you're trying to accomplish. The drawback of Walter's investment strategy is, which I don't particularly like, is that you have to be buying into the weakness, and that opens up a whole Pandora box. What is value investing, and like all those kind of things. I used to go down that route, but I have learned from my own experience that this doesn't work for me, to keep buying into things that are not working out. And I'll explain why. because when you're buying into something that is not working out, you are inevitably saying, I'm smarter than the market, and the market will come around and agree with me. Now, this is not the place to satisfy someone's ego. If in investing, you need to know like what you're trying to accomplish. I'm not looking to invest to kind of make myself sound bigger than I am. I'm here to make a suitable return. So you need to know that what's your strategy and what's not. The other drawback of that of Walter's investment strategy is that he was very diversified. He owned about 100 stocks. Now, that is a headache, okay? That is really, really difficult to do. And I haven't got that temperament. So again, it doesn't matter if your strategy aligns with mine or does not, it doesn't matter. What matters is that you need to know what you are trying to accomplish. I need to work extremely hard to refine and optimize. I'm going to bore Tomas for a second. I'm going to repeat what I said last week. There was a stock last week, maybe it was 2 weeks ago now, things have just merged into one. Samsara, its ticker is IoT, which stands for like investment, Internet of Things, IoT. And this was like in my flipping sphere of competence, man. I've been following this company for such a long time. And I'm not being a hindsight investor. I didn't invest, I didn't recommend it, blah, it's gone. But, this should have been mine. And I've been working on this for quite some time, and I'll come back to this on the end of the conversation today. But, like there's a lot of things that are working here in the market, but you don't need to kid yourself as well. Just because everything is working right now, don't think that it's going to continue working going forward. So that's about Walter's strategy, kind of to give some context there. The other investor I'm going to talk about is Joel Greenblatt. So Joel's investment strategy over those 13-year period, he delivered for his portfolio 50% annual returns, annualized. So 50% per year, kind of. Now, his strategy, he makes it sound quite simple and straightforward, but he's an extremely intelligent individual. And to think that, we could duplicate that is really quite difficult. In his book, You Can Be a Stock Market Genius, he doesn't really talk about very much the fact that he was using a lot of options and different mechanisms, because he targeted that book towards a general investor. But I have followed his work over time, and I have come to understand that, yes, he did use a lot of options, but certain ideas, again, continue to take place. And now, when I talk about Joel's strategy, I'm not talking about the magic formula. The magic formula is quite popular, people like it, because it's simple to understand, but what he was doing a lot of groundwork on those kind of stocks and looking for kind of odd things, things that are spin-offs, in special situations. And this type of strategy is really difficult to do. I've tried. The problem is you need your special catalyst to work in a timely manner. Because just because a company is spinning off something and it spins it off doesn't mean you're going to get rewarded straight away. For me, this didn't work with Tech Resources. I've been recommending Tech Resources, the copper miner, for the best part of several months now. I think it was, can't remember now precisely, I think it's about 8 months, something like that, which, for me, it's kind of, should have hopefully worked out by then. It's kind of just stuck around, hasn't really done anything. But they did announce this, that they were going to finally spin this half of their business, the coal mining business, off, and that they've actually got the buyer, and the buyer is going to give them $10 billion. So it's like, if their market cap is only 18 billion, like they're going to have like over half of that coming in as cash, which will give them lots of stuff, lots of capital to kind of do interesting things with. But again, this, even if I kind of had this thought process going into it, these things kind of take a long time. And I know from Joel's work that he normally would invest for these businesses for about 2 to 3 years. But let me tell you, like, when something is kind of taking a long time, you're full of doubt. And you're like, am I actually going down the wrong path? And because, as an investor, you're not only trying to get the return, but you're working against time as well. So you need to have the right idea, and it needs to work out in a timely manner. So these are two aspects which are really, really difficult. And if you add on top of that option trading, it's like everything gets speeded up in time, and it can go both ways. And I know for myself that this hasn't it's just been too difficult. So that's one thing that I don't like about Joe Greenblatt's strategy. But what I do like very much, and this really cemented it in for me, he said that he's only looking for these businesses to have high returns on invested capital. And it's something that is so simple to understand. And it's ultimately something that is really, really just cuts through all the BS. Hi, George. Can you hear us, George?
Hi. Yeah, hi.
It's so just talking about like the investors that kind of help me think about, and then at the end of the conversation, kind of open it up because a lot of things are happening in the market. So I'll continue. So with Joe Greenblatt, you talk about return on investment. Now, ROI. This is so important. The way that I've attempted to think about it, this is all aligned, but the way I've attempted to think about it is the free cash flow margin. For people that are not familiar with it, this is your free cash flow divided by your revenues. So you get a free cash flow margin. I like businesses that have a high free cash flow margin. You will find that normally, if you have a business that has a high free cash flow margin, this will translate into a high return on equity and a high return on invested capital, which is what Joel is doing, but Joel's strategy just explains it in a different way. Perhaps because when Joel started investing, it was in the period of, let's say, around 1986 to about 1999, that ballpark. So there weren't as many software businesses. So, he was looking at, say, businesses that were quite capital intensive for the most part. I know after 2000s, it kind of moved on beyond that, but I'm talking about when he was in his prime doing those kind of returns of 50%. What are the key principles? So I believe that the combination of the high return on invested capital combined with a concentrated portfolio. Now, the first thing you're going to do when you're an investor, if you kind of, if you're generally quite, you guys on the call here are obviously quite preoccupied about investing and thinking about it, is you're going to go down the route of being highly concentrated. And I have been down that route and I've lost a lot of money on that route. So I can say, no, realistically, it doesn't work. And the problem why it doesn't work is because you don't know until after the fact the things will correlate it. You like things that like the example that I like to throw up there. Now, obviously, after the fact, it's all common sense and everyone knows this stuff. But the example that I was liking at the time to describe is if you looked at something like Square, now they call Block, but back in 2000, back in 2020, they were called Square and Wayfair. These two businesses, from 2020 to 2022, you could just align their share price, like just basically, they just overlapped pretty much. And one is obviously selling furniture for your home, and the other one is facilitating cash payments digitally. Now, very, very different type of business model, but their share price was aligned for those 2 years. And what they were really playing off was high liquidity and low interest rates. But you know that today. But when you're going through those 2 years, it's really difficult. And sometimes these things look diversified, but they're not. And that's just as a segue, I'll just briefly mention, that's why I always say to everyone, when it comes to investing, spread out your investments, because oftentimes you're like, oh, this is interesting and this is interesting, and things are working out because you're exposed to a certain market factor, but you only realize that after the fact. Tomas, were you going to say something? Like you put your hand up. Do you want to say something? Okay. So that's the thing that the drawback of being a concentrated investor. And now I'm going to talk about the final investor, which is Monish Pabrai, and what I've learned from Monish. So what I particularly enjoyed about Monish, it's a very simple strategy. Now I'll come to the drawback of his strategy, and then I'm going to bring out and explain what I do like about the strategy. The drawback of Monish's investment strategy is that he's looking for cyclical businesses that have hit a temporary difficulty, and he's expecting them to turn around. So you buy these businesses that are making a lot of earnings, and they are just a cyclical part of the business, and you expect them to turn around. The problem is that these cyclical businesses rarely turn around, and the market knows that, and that's why they're so priced so cheaply. So just as an insight, back in 1999, I think it was, the one that he bought, I can't remember the name of the cemetery that he bought. It was like there was a publicly traded company, which funeral homes or something like that, and it was priced at like 1 or 2 times earnings. But that investment just soared. It just went through the absolute moon, and that was responsible for a lot of his strong performance in the early periods. But those turnarounds happen infrequently, and he kind of stuck to that. And recently he's bought into that coal miner. It's a met coal business. They sell coal that is made to produce steel. It's the ticker is AMR, and this I was also invested in Arch Resources. This is kind of the same idea there, but you are buying very cheap future earnings, very, very cheap, like 4 times future earnings. But I know that the market doesn't price those mining businesses very highly, because at the drop of a hat, the price of met coal, what AMR produces, can drop, and what look like very juicy earnings can just erode very quickly, because there's very, very high fixed costs in that business. So you have very high fixed costs, but you have a bit of pricing power. Things work out really well. Everyone is happy, everyone's singing and dancing, strong operating leverage, and everyone can talk about share repurchases and dividends, and everyone talks about all good stuff. But when the price of the met coal slows down, what look like really juicy earnings all of a sudden just evaporates, and because you still have the very high fixed costs. So that's the drawback of looking at something like Monish's investment strategy. What I do like very much about Monish's investment strategy is that he talks about the 2 to 3x in 2 to 3 years. So just you're thinking like this. Well, it's kind of, when I came to investing, just kind of help me out, lengthen out my time horizon, because it's like 2 to 3 years is not the end of the world. It's not like I'm buying something and I'm waiting until I die. It's kind of, it's a reasonable time frame where something could positively work out. And I typically like to hold things for about 18 months. If I feel that it's just on the cusp of maybe something working out, I'll lengthen it out a little bit longer. But I don't like to kind of wait for a very long period of time, because I'm trying to buy those kind of inflections. The inflections is like a buzzword, but basically it means that I'm trying to buy those businesses where the narrative can change. And when the narrative changes, there can be quite a lot of strong free cash flow in the next year or so. So that's what I'm trying to do. Now, when Monish talks about the 2 to 3x, it just kind of takes a lot of the pressure off. It's like you don't have to kind of go for those investments that you are hoping will go to the moon. It kind of just makes it more grounded, more realistic. And this really helps me out, because it just kind of says, you don't have to be a hero. And I often think about it, right? When things are working out in the market, it never matters how much money everyone is making. The only thing that matters is how much you're going to keep at the end of this period. That's the only thing that matters, because making money is really easy, man. Like I've had good periods, I've had bad periods, but you need to just be really brutal on yourself. That when something is not working out, just take it easy, just calm down. Maybe sell some. If you sell some and say, okay, do I really want to buy it tomorrow morning again? And if you don't, maybe that investment is not for you. And it's okay to sit on your hands. A lot of people take like a personal grudge against a stock. Like the stock is going down, it's like, oh, I'm gonna buy more of you, see if it turns around. And this is not like, don't try and be too emotional about investing. Try and be quite reasoned and understand that on the other side of the trade, there is someone that knows just as much or even more than you about the stock. So that person is either selling to you or something, they know, they've been in the stock, they know why they're selling the stock. So just think about a little bit more of being quite rational in terms of investing. And I'll kind of open it up just as part of the talk if anyone wants to say anything about these free investors or any investor that kind of like resonates with them. And then I've got another topic at the end if anyone wants to talk about that. Okay. So the other topic that I want to talk about, so kind of alluded to this a little bit already. Right now in the market, things are working out really strongly. It's like it's mental. Things are working out really strongly. I strongly suggest that people don't believe that this is the new normal. Things are really extended. There's a lot of optimism in the market. Just lengthen out your buying or selling your stocks, because you don't know how things are working out. Stick to those principles of buying things that have a clean balance sheet. This is, I can't drum that in enough. If you start with a clean balance sheet, after that, positive things can happen. That's it. Positive things can happen. But if you're buying a balance sheet that's like full of trouble, and I've explained already, you don't need to be like really in depth with this. Just look at how much cash there is in the balance sheet. That's like, a couple of minutes. Look at how much debt there is against that. And just think about that a little bit, just say, okay, if the business, for example, the business is making about 2 billion of free cash flow and there's 2 billion of debt. Okay, the business can pay that out in about a year or a year and a half. It's not the end of the world. It won't be difficult for them to tackle that debt profile. If the business is making, let's say, 2 billion of free cash flow and he has, let's say, 6 or 7 billion of debt, just say, whoa, that's a good rule of thumb for me. I like to use is about, you don't want to go above 2 times the free cash flow. So if the business is making, let's say, about 2 billion and once you subtract the cash from the debt, you have more than 4 billion of debt, to say, well, that's a lot of debt. It's a good rule of thumb to just think about. I feel that there's plenty of things that are positive working out in the market right now. Like, just think about that. And the other thing that I feel that is really, really important is a lot of these businesses that have gone through this cycle have had to make tough decisions, because in 2023, people that have been coming on this call for several months, I've been going on about Farfetch for so long. I've been saying that business is gonna collapse. I've been saying that time and time again, and I just said, it is too much debt, and when there's a lot of debt, you are needing that business to be absolutely outstanding for it to deliver, to be able to overcome a high interest rate environment. And you don't want that. You don't want it to be that you're betting on interest rates coming down. That's a really tough bet to make. It's much better to buy a business that has a strong balance sheet and is making some free cash flow. Obviously, you want the business to make more free cash flow next year than it's making right now. Okay, the common sense. But just think about the balance sheet. It doesn't take a long time. I was speaking to someone in the chat before, and I was just saying, it doesn't take a long time. If you just look at how much debt they have, and if they have quite a bit of debt, just look at when that debt is due, they gave the example of Builders First Source. So that's a business that I own, and they have some debt, but the debt is staggered all the way to 2032. It's like that's not going to cause any problems. That's, just thinking about these kind of things is quite helpful, because you need to know what you own. And it's sometimes, when share prices are moving up or down really quickly, we kind of feel like we should do something, we're going to miss out. But I've been saying that the whole year, no stock goes up forever. And I've been saying about NVIDIA. Look at NVIDIA. It's kind of like it went up, and then everyone was like singing and dancing about AI and AI this and AI that. And then, like since about June time, this is kind of like flatlined. It doesn't mean that next year it won't go up. I don't have a position in NVIDIA, but I'm just saying that even the best companies, there's no such thing as a secular growth forever. Businesses go for good periods, and then there's periods of the consolidation, or periods of kind of digestion, whatever you want to phrase it. Okay, yeah, I kind of want to put it over to you, because I know like you guys have good ideas as well. I don't want to just talk forever. Do you want to share something, Tomas? You always have something to say. Do you want to share something?
Oh, not necessarily. Perhaps I had one observation, not only about three investors that you mentioned today, but also the former ones. It may seem obvious, but it's worth noticing for me that these guys really did diligent work on the companies they had. So if we are to mention the top 10 investors of all time, everyone may have a different list, but perhaps one of these top 10 will be a guy who just played momentum or was a trader. Usually it's all about diligence in investing.
Yeah.
It's also in a way about avoiding analysis paralysis. So having a strategy, a clear set of rules, like you mentioned, debt and cash flow. So some guys specialize in turnarounds, some in other stories. But so first of all, there is a need to do a diligent work in investing. And second of all, it's not cutting the corner. It's about being very, I would say, I'm searching for a term. It's knowing how to analyze stuff in a way that you get more answers than questions. And then do it for 30 years and you are rich consistently.
I'll also just add that, it's like an athlete whereby you are trying your best, even when you don't feel enthusiasm for it, to stick with it. Obviously everyone feels super enthusiastic when share prices are going up. That's obvious. Share prices are going up, everyone feels super enthusiastic about investing. But also it's very, very important to stick with it when it's not enthusiasm, there's no enthusiasm for it. And that's really much easier said than done. But that is the moment where the money is made. The money is made in the periods when everything is going to hell and you're trying to just slow down everything going to hell. That's when the money is made. If you can just reduce, going back to Warren's letters, he explains this very nicely in shareholder letters when he was doing the partnership years. The outperformance will be made in years where the market is down and we're down less than the market. It's kind of said more beautifully because it's Warren than me, but that's where the money is made. The money is made where you just cap those losses. And it's like you read over Warren's letters in an evening or a couple of evenings, but that's 13 years of hard work by the best of the best investor. And he kind of just distills that into a few paragraphs. It's quite a different thing when you're going through the motions, and it's hell, it's really, really hell. But you need to take those learnings that you have accumulated, and you need to kind of, the best way I find to explain it is, a lot of investors in the financial crisis kind of took a massive loss, and I understand that, but then it took until about 2014 to come back in it. So, and I recognize that, I can very much understand, it's not time for investing, and you kind of get distracted and you forget about it, and time passes really quickly, and then before you know it, oh, I think I'll go back into the market and start like, but the problem with that strategy is that you miss out, and you don't need to be like doing this all the time, but you do need to have a process that allows you to grow alongside your investment strategy. You need to kind of keep having this multidisciplinary, curious mindset to keep at it when things are not working out. Because now when things are working out, all that work that I put in the last 2 years, I'm like, okay, now I'm getting paid. Like it's always like a spring. So, but that's because I was really working very hard when it wasn't like, there was no motivation for it. And now I'm like, okay, now things are like really nicely turned around. But don't expect things to kind of always to be in your favor. You need to have that process in place. Maybe it's 2 hours on a Sunday, whatever, I don't know. But it's a routine that there's no questions asked. Oh, what shall I do today? It's like it's in the schedule, it's going ahead, no questions asked. Feel good, feel bad, I got a cold, doesn't matter. Step up, that's the time. You're 2 hours on Sunday, whatever it is, you go in and that's it. So because those little bits every Sunday or whatever, those little bits add up, and they really do add up. And I've seen that with myself. They add up, they definitely do add up, but it's not immediately obvious that deferred work a person is putting in. Yeah, so that's my passion, I'll speak.
We like your passion, that's why we are here. Also for the money, but passion plus money, it's a good combo.
Thank you. And George, do you want to say anything, George?
Well, I've been on vacation. Sorry, I missed last week and late today. I got in very late last night. Is it still? You mentioned before. This is almost 2 weeks old, but you said the market being frothy. Is it still frothy at this time, or things
Frothy,
changed?
yeah. It's like it's beyond mad. Like
Oh,
it's beyond. I can't justify it anymore. This is gone bananas. Yeah, the definitely very frothy. I stick to what I said. It's important to just lengthen out the process. No one is missing out anything. There's no kind of fear of missing out. The market will be here in 4 or 5 weeks' time. Nothing is going to change. There will be new opportunities coming around. And if you feel like, oh, I should have bought this, that, the other, just think about it. Just lengthen it out, or drop me a line. I can explain. Okay, this looks good.
okay.
Perhaps this doesn't look as good. Just drop me a line, or just speak to me. I'll say, Michael, like you did with UEC, and we kind of spoke about it a little bit, and kind of explain. Okay, this is what I think. I recognize what you think, and we can have a discussion about that.
Okay. I have a follow-up question. I noticed that it was days afterward. I wasn't checking the market while I was gone, but I noticed that when you said buy Sentinel 1, is the whole market listening to you? Because you said it before the market opened and then skyrocket.
But no. Well, I wish. It was already up 15%, right? It was already up 15% when I wrote that piece.
Oh, okay.
So
well, it seemed I saw that the day, you said it early in the morning, it's like 1 a.m, and then when the stock when the market was open, it skyrocketed up, and I was like, wow.
Yeah, but it was it was already up on the post market. Do you know what I mean? So on the post market, it was already up 14%, and then on the pre market, it was up 15%. So yeah, but listen, I mean, hand on my heart, I believe, I don't want to speak my book too much about individual positions, but you can ask me a question about this, but I honestly think that Sentinel 1 is going to do quite well over the next, let's say, 12 months. The reason, so this is what I'm trying to look for. I was trying to explain at the start. I'm looking for these inflections, these change of stories. So I've been following Sentinel-1 for a long time. I've been like, this is junk, this is junk, this is like, nobody, this is like, I was going absolutely mental about this. But the one advantage that I have, in my opinion, is that when I see that something has changed, I'm
that's right.
very happy to change my mind. And I don't need it to be like 2-3 times like batting over my head. If I see the facts change, I'm your man. And what changed here is that they were gone from so unprofitable, like crazy unprofitable, to just kind of unprofitable at negative 11% operating margin. Now, I recognize negative 11% is crap, right? I get that. That means so every dollar they're losing 10 cents. I get that. That's crap. I understand that. But they've been going from approximately minus 50% to like minus 30 to minus like 11 in a space of 12 months. So it was like, whoa, this is such a massive change. And I was like, I extrapolate that further, that trend, and I think, okay, this time next year, they're going to break even, okay? So that's my thought process. This time next year, they're going to break even, so that this time next year, people will be thinking that this is a profitable business. And when that happens, that multiple will expand. Do you see that, George?
Yes.
That
Yes,
is what
thank
I'm
you.
trying to explain.
Thank you.
It's a lot of words, but it's really, really simple. They are going from being unprofitable to profitable. That's it. You can add some jazz about it, like cybersecurity, blah, blah, blah. But it's basically this. The business is rapidly growing, and it's going from unprofitable to profitable. Once it becomes profitable, it's a viable economic enterprise. And then it's like, then you can just then it sells itself, the stock. But from around this point, I honestly believe from around this point to the next 12 months, I think that there's going to be like a reasonable return to be made. Yeah, but listen, then I also said the same thing about PayPal, and I was just as enthusiastic about PayPal, and it's only up a few percent. So, take each thing that I say with a pinch of salt. Yeah.
Thank you, Michael.
Do you want to add anything to Maz before we go?
Oh, a lot, but perhaps I can write you an email as promised.
Okay.
No,
I
but
look forward to it.
one suggestion for the next meeting.
Yeah.
I would like to learn your opinion, and it's also inspired by Warren Buffett, about the role and the quality of management of stock companies. How to include it in your business thesis, whether to include it or not.
Mm-hmm. So I'll give you a very quick answer for that, because it's a question I get asked all the time, and I have the answer. I know that I can't tell these guys from anything, so I don't avoid that. I avoid that 100%.
You avoid it. Okay.
I avoid it 100%, because every CEO has a job to sell everyone on his or her vision of the company. So just like they come up with a passion, Elon Musk or whatever, like Jeffrey Epstein, whatever, like these guys like come in and like they like move the room around. But ultimately, it's very much of a distracting information. I believe growing the free cash flow is really what will get you rewarded. Try and focus, in my opinion, focus on one or two variables that you can understand and control and can quantify. If you're like Warren, you can pick up the phone. Even when he was like 30, you probably could do that. Pick up the phone, speak to a CEO, have dinner with them, this and that. Get a feel for the person, ask his friend, like different ball game. I believe that is in our process, the distraction information, but we're making quite enough without that. So it hasn't slowed us down. Okay, guys. Okay. Thank you so much, man. Thank you so much for coming. I'll see you guys in 2024.
Okay.
Thank you.
Take care. Bye.
See you soon. Bye-bye.